Hello, ladies and gentlemen. It's Wednesday and investment show as usual. And today we'll be joined by our technical director, Nguyen Phan. Hello, how are you today?
How are you doing, Sasha?
Okay, very well. Let's start our program because there are a lot of very interesting things happening in the market. It appears to me that it's doing quite well, at least last 3 days. And there are a lot of reasons for that, although there are some people who believe that all shares are overpriced and the correction is due. But there is another opinion, just as valid, is that there is abundance of money on the market. There are trillions of dollars fueling the system, and there is no alternative to us buying stocks because there is neither bonds or any other investments like whether it's gold or Bitcoin or anything like that can compete with stocks. We can even talk about something what's called stockflation. It means that the prices of stocks, because the cash is losing its value because of low interest rate environment, so the stocks have nowhere to go but higher because more and more people are competing for the same stocks. There are so many shares of Apple or Microsoft or Nvidia or other leading stocks, and people are competing. They want to buy those stocks, whether directly or through mutual funds or through ETF or any other different vehicles, but there are still everybody, even index funds. If you're talking about index S&P 500, they're all investing in the same stocks: Microsoft, Nvidia, and Apple, and probably Netflix and Facebook, and so on, and a few others. So that means there could be what we're talking about, stockflation effect. I tend to gravitate to high-paying, high-yielding dividend stocks, as my major concern is a preservation of capital. So these high-paying dividend stocks probably they provide you nice dividends. Say on average 6-7%. Some paying more, some paying less. For example, when I bought Pfizer, Pfizer was paying a 5.5% dividend. It's a little bit lower than what I have some other stocks are paying dividends, but still it's quite respectable. Specifically, Pfizer is a fantastic, well-run company with a lot of patents, a lot of drugs such as Pfizer against coronavirus and many other developments. However, now, since it's run quite a bit since I bought it, now it's paying only 4% dividend. So what, should I sell it because it's paying only 4%? Not really, because, well, 4% is still respectable dividend. Well, actually, Pfizer will continue its run and will not raise its dividend. It will go to 3.5%, maybe even to 3%. So then my reason for owning Pfizer will be somewhat different because it's no longer will be a high-paying dividend stock, but it will be still a very good stock of a very well-run company. And Gwen, what
So
your
Sasha, what is the lowest percentage dividend should you pick?
as a dividend yield?
Yeah.
Well, look, if Pfizer is still high-paying dividend stock, so say 4%, probably it will be my lowest entry point. The highest, I mean, if it's paying 50% dividend, I will definitely take a look, but something is unreal about that situation. So I'm not looking for that. But there are some really good stocks which are paying 8%, 9% dividends. MPLX is a very well-run company. It's paying about 9% dividends. I own a couple of tobacco stocks. People don't like tobacco stocks because they're not environmentally friendly and so on. But even they develop new products or so on, and still paying some companies 7.5%, 8% dividends. British American Tobacco is one of them. Altria Group is another one. Or you can even take a look at Enbridge. It's a Canadian company which owns a pipeline using basically gas, a little bit of oil. It's also paying 7.5% dividend, and stock is doing quite well. So this type of companies you can use for your long-term investments. So essentially, although you can enhance your profitability by selling options like covered calls against your stock position, I'm not doing that with this particular stock simply because I don't want them to be taken away from me through exercise of, for
Mhm.
example, covered call. It happened to me a couple of times. I had Canadian bank, CIBC, and a day before it was paying dividends, the stock was called away from me. So I missed the dividend payment. Okay, I made money both on stock and on option, but missed dividend payment. So you have to be mindful of that. But if you have long term strategy, you might as well just own them outright and just enjoy the ride. I even noticed one thing when there were a downturn in the market last week or so. These dividend stocks didn't go down as much as the market did. If market did down, say 5%, the stocks went down maybe 1-2%. So on very quickly recovered in the last 2-3 days. So it's probably I would qualify it as not only as high paying dividend stocks, but as a very well founded defensive position.
Mm. I think from what you said, it's very important to note that the start and the stop of the dividend give out is important. Let's say this is the end of the month, you have to wait until the next dividend push for the company to give you the dividend. I think.
Well, some most of the companies are not paying every month; they're paying quarterly dividends. And
Mm.
you can even on Yahoo Finance, you can always look at the company and when and how much they're paying dividends, and when there's so-called the cut-off date. It calls ex-dividend. Let's see, a company paying dividend to all those shareholders who are on record. Let's see that it could be, say, for example, September or August 30th. So on August 30th, whoever is shareholder of the company, those people will get paid dividends. Let's see, in 2 weeks in September or 3 weeks, depends on their dividend pay
Mhm.
date. Okay, now if you sold the stock before that date, even one day before the date, you will not be entitled to the dividend. So you
What
always
what
have to.
what would happen if you get stuck in between the quarter? Would they still give you the dividend prorated?
Oh yeah, you can buy the stock even a day before dividend payment. You'll still get the dividend as long as you are on record that particular day. You don't have
So
to be shareholder all quarter. You can do it in the last day, 5 days before the end of the quarter. I would recommend buy it maybe a couple of weeks before the dividend payment because stock normally goes higher because there are a lot of people who want to participate in the dividend payment. So in the last few days before the ex-dividend date, a lot of people are willing to buy stock.
that makes sense.
Yeah, that makes sense. Absolutely. Now, there are some companies I have, for example, GDV. It's a Gabelli Dividend and Income Fund. Now, that stock is paying dividends monthly on 10th of each month, as long as you're on record, of course. So you know, the monthly dividends are coming every month. And, it's quite addictive because if I would sell stocks, that would be the last ones that I would sell because when every month coming some money, so you think, oh my god, if I will sell the stock, I'm not going to get next month's dividend. So
Sure.
of course it's quite big motivation for some people to keep the stock.
Yep. Yep. I mean, that's pretty good every month. Just
Yeah,
just like the bank.
yeah, yeah, and it's an expensive stock. It costs now probably what, $26 GDV, and it's paying now. When I bought it, it paid much more. I bought when the stock was I think $14. So at that time, it was paying almost 9% dividends. But now it's 26, so probably it's paying only 7%, maybe even less, actually.
Mhm.
But again, because of monthly dividends, it's hard to it's hard to sell.
Yeah, yeah, yeah. Totally. It's better than the bank. So much better.
Oh, don't! It's not even a question. What bank is paying these days? What you'll be lucky to get 1%, maybe,
Yeah, half a
and that's
percent,
all. What
1%.
Yeah, that's all what you get. But don't forget that if you bought, let's see, even today, if you're buying at 26 and it will continue to rise, and most likely it will. So not only you are getting monthly dividends, but your capital will appreciate because of the higher prices of stock.
Yep.
So that's uh, quite sound strategy. Okay, I think before we are going to the next segment, maybe you will do a presentation. Last time I did on Saturday show about correlation between chess and investments, and maybe we'll talk a little bit more about this coming Saturday. I will have Professor Ken Regan on the show. So let's just give people a taste how the show looks.
Okay. Let's watch it.
Thank you. Thank you.
Actually,
And we'll do this show at 1 o'clock this coming Saturday. And now, the second part of our program, I'd like to talk about options. The options is basically conservatively used. It really enhance your profits on investing. Now, how it works, I will start with a very simple idea, which I did just the last couple of days. It's a strategy called covered call. What means covered call? It means that I sell somebody a right to call the stock away from me at certain price within certain time limit. Um, for example, I had used a strategy, for example, on Monday, when markets started to go higher, I figured out that most likely the the stocks, and I'm talking about high flyers such as well-known stocks like Microsoft and Apple and Nvidia and others, they most likely will continue to go higher. So triple Q, it's essentially ETF invested in top 100 Nasdaq stocks, must go higher, at least in my opinion. So what I did, I bought the 100 shares of ETF and sold a call. Each call covers 100 shares. So I sold one call. I think it was 274 um, call, but I sold it 276 call, so to have a little bit cushion for more profit. And I was paid, I think it was $2, but $2 on 100 shares is $200. And now, so what I created is I created a little bit of a protection. If index will not go as high as I'd like, but stays the same, or even go a little bit lower, I have $2 protection. So even if I'm not right, I have $2 protection. Number two, If stock will continue to rise, so I will make a profit on this call, and I will make a profit on the 100 shares that I bought. Now, when comes Friday, which is called the Friday expiration date, then I will make a decision. Okay, let's say I've sold 276 call. Let's say stock is trading 277. So obviously, if I will not do anything, stock will be called away from me at 276 because it's a rise of call, although it's trading at 277. However, I was paid $2, so I'm actually making $1 on option, and I'm doing $2 on the stock. So I could end up winning $300. However, on one position, if I have 10 positions, of course, it's 10 times more. Now, however, on Friday, I can, depends on the market, depends on a lot of factors. I can make a decision to buy back the call during Friday when the market is open. It probably will cost me the same money, maybe even at some loss. If I will pay more than $2, let's say stock is trading at 278. It will cost me more than $2 most likely. So I will lose a little bit of money on the call, but stock, the triple Q, it went up from 274 where I bought to 278. So I'm making $4 on the stock position. And on Monday, I can sell next call, say September call, and generate even more cash. So this is a very defensive in a way. It's not aggressive strategy. Actually, I would qualify it more as a defensive strategy because you, uh, unfortunately, you're not participating in a full for movement of the Nasdaq stocks because now maybe index will go higher 10 points in one day, and you by selling the covered call, you are actually taking only a fraction of that move. However, if stock is staying the same or even going a little bit lower, you have a good protection. Uh, now, I think there was a question from audience about defensive stocks. I think from Ankit. You're talking about probably defensive stocks like Raytheon, like
Yeah,
probably
military.
yeah, all the military equipment. Well, this way, I mean, you can buy those stocks. Do you think that these stocks are better investments in Nvidia or Netflix or Microsoft even? I'm not so sure. But they could be good, but I don't see why you're, on one hand, you're getting your troops out of Afghanistan. So they will all come home wherever they're going to go. Um, So why would then U.S. need even more military equipment if their troops are going home? So they will need even more equipment to do what? Obviously, U.S. at this time they're reluctant to fight any wars with anybody. I
Hmm.
mean, if they want to fight the war, they should go to Grenada. This is a very good place to fight a war. They will win for sure, and they will overpower Grenadian army easily. And but for that, they don't need a lot of new equipment. Actually, they should utilize their old equipment instead, and then they will order new equipment. Okay, so that's how it goes. Um, so, I mean, if you have probably you own, if you have some investment funds, ETFs of some kinds. I think there is an ETF which invests only in these defensive stocks, but I don't believe that they can compete with stocks like Nvidia for sure. I really don't see that. But
Maybe there's a dividend paying defensive stock somewhere.
they used to be, Boeing used to pay dividends, but after it collapsed about a year and a half ago, obviously they stopped paying dividends. General Electric almost doesn't pay dividends. It's very hard to find good defensive stock which paying high dividends. I don't think. I mean, I have to look into it specifically. I just saying from what I remember. But if you really will take a look, maybe there are maybe Nordstrom, maybe they paying, but even I'm not so sure uh,
Mhm.
how big is their dividends. And also, it used to be even 20, 30, 40 years ago, there were very good defensive stocks. They were paying dividends, and there was always need in new arms and equipment and so on. But these days, I have difficulties with this. Probably whether right or wrong, I, at least I'm myself. I'm not a buyer of the stocks.
Do you think there's enough options trading in the defensive stocks to be able to do options?
On defensive stocks, okay, you see, the reason for options trading is not in what industry you are. I mean, if you believe that stock will go much higher level, so the most aggressive strategy, of course, is not to sell call, but to buy call. But with that in mind, you have to know that in all history of option trading since 1973, when they started on Chicago Board of Trade, there was only 1 year where option buyers prevail over the option sellers, and it was obviously 1987, the year of the crash, when Dow Jones in 1 day lost 22%. So all other years, the buyers of options were losing to sellers. So I would rather strategically be on the side of a seller rather than a buyer. Because when you're selling options, basically all you're saying, all what you are selling is actually a time. Somebody is buying from me time, and I'm a seller of time. And when I'm selling time, so the time slowly going down, and it goes like one line, and then it starts closer to expiration. It starts to quickly deteriorate almost to zero. So I'd rather sell puts and calls rather than buy anything, generally speaking. Although in some situation, but even that, what I know is that most likely I will make money, but I'm not doing that because again, it's risky and it's not part of my overall strategy. For example, let's see if Apple reports next week, right? You can buy, say, 2, 3 days before the report, you can buy both calls and
Mhm.
puts. What you're doing is you're betting that there will be a substantial move one way or another. And obviously, you will lose on one side, but your win on the other side can be very substantial. But I don't know, maybe if I would be, I don't know, 10, 20 years younger, I would use that strategy more often. But now, if I would win money, I don't think that I would enjoy it that much. No. Okay, that's about option trading. So right now I have, for example, position in Zoom communications, right? So what I did, I sold way out of the money put, and I sold way out of the money call. There were extremely good premiums on both puts and calls. So I couldn't resist the temptation to sell both, although um, I hardly can win both positions. I will lose one of them.
Yep.
But the premium generated by selling was well worth, even to take at the end of the day a loss on one of the legs. But I already collected good premiums on both legs anyway. So I'm quite happy with this position. The only thing is I sold very long time expiration. That's why the premiums were so good. I sold January 22nd uh, puts, and I sold June 22nd call. So by the time the beauty of it is that by the time that I will be exercised, the stock today is what, 330, 340. I'm not even looking at the stock quite often, but I sold 500 put. So most likely it's not going to be 500 by the end of January, by
Right.
the third Friday of January. So I will be excited. Let's assume that most likely stock will be say $400. So I will be on a paper. I will be losing $100 per share. But remember that I've collected $216 in premium. So even though I will be still on the plus side on that, and also it will create a nice cushion because against my call position, let's see, theoretically speaking, the Zoom can go up to, I don't know, $1,000 a share, right? So what's going to happen? Whatever call I sold, I will be exposed to huge losses. But by the time that I will be exercising my put, I will be having essentially synthetic covered call because I will be exercising put. So I will end up with each position 100 shares. So the calls that I sold, doesn't matter, it will go to 500, 1000, 1,000, 5,000, doesn't matter because I'm already protected by shares themselves. So I can always deliver the shares. So that's a little bit more complicated strategy. But in my opinion, it's a sound. It's probably not for every investor. It's I'm attracted to that because almost like a chess game. You make your move, and then you see what market does. You make your move. Now you know your defenses. What's happened if the market does this or that? So you know what you're going to do in this case. You know what you're going to do in that case, and therefore you sort of. Although maybe other people in my situation would be very nervous because oh my God, what's happened if the stock will go to $1,000? Then you have exposure, you will be exercised, you will be doing. But I think that I have good answers to that.
So, Sasha, how many chess players are finance people?
What do you mean, finance people?
They're finance savvy, like
Oh,
you are.
finance savvy. Um, you know, it's hard because you have to generate certain percentage, and of course, I think you would have to do survey to get any meaningful numbers because I know some of them are very good investors, and I remember time when Bankers Trust of New York they hired a lot of grandmasters to do proprietary trading and different investment models or so on. They were very successful. But other than that, I have few friends who are very successful as investors. They're doing mostly private investments, and but again, to do a little bit like maybe a survey would help really to figure out that. And
So,
of course,
are the grandmasters still for hire for this purpose, or is it old strategy that the finance companies use?
I know these days I think the companies are using a lot of proprietary computerized trading. I think
Hmm.
that's probably where they're going, and they're doing like little increments of each 1/16th of a move or 1/8, half of a cent or so on, and they're going all day in and out, in and out, in and out. So, in that department, human beings cannot compete against
Right.
computerized trading. So your horizon should be much bigger than much longer than 5 minutes or half
Mhm.
second or even 2 hours. It's then if you want to do that, you're going in the area of a day trading, and you will always lose against computerized trading, unfortunately.
Yep.
Okay, I think we'll finish today's program. Thank you so much for assisting me, and we'll see you all in next Wednesday. And don't miss our chess show at 3 o'clock Saturday. Thank you so much. It was investment. Gwen, thanks a lot. Bye bye.
Bye.